A very good morning to all the students. Welcome to the 19th live webinar on the practical training module for all the CA students. Today with us, we have my council colleague, Pramod Jain sir, and he is the senior most in the council from 2019 onward. In addition, he is the chairman for the two important committees, Accounting Standards Board and Expert Advisory Committee. In addition, he is a member in almost 25 committees, boards or directorates, and he is a fellow member of both Institute of Chartered Accountants of India and all the sister concern, company secretary, cost accountant, and in addition, he is also a law graduate. Also, we have with us two eminent speakers today, Alok and Neha. Let me share you, in the current changing scenario and technology world, it is all about the practical training what a student needs. Considering that the council has decided, in addition to the theoretical and the articleship, every student needs to have hands-on exposure on the practical aspects of it. So taking that, we have started the live webinar and there's a 19th one going on. Request all the students to share the same along with your friends and colleagues. On every Sunday, we'll be having the same from 10:30 to 1:30. I really appreciate the entire secretariat and the staff of ICA for taking their valuable time even on Sundays for the benefit of the students. Today, we'll be having the most important topic, the practical implication of accounting standard, both while finalizing as well as during the audit of financial statement. So I'm sure that the two eminent speakers will take you through and have the question and answer session. Request all the students to put forward if at all they have any query or any specific question. You can also key in on the chat box. We'll get back to you on that. And today, I request my colleague Pramod Jain sir to kindly have his keynote address. Sir, this is the 19th module, sir. On an average, 10,000 students are attending the live webinar in addition to our recorded sessions. So thank you, sir, for sparing your valuable time. Request you to kindly have few words with our students. Thank you.
Thank you very much, Sridhar Mupalaji, our a very dear friend and new entrant to our council, which Hyderabad has given, the central council member from the southern region, and the knowledge which he has. I'll not talk about knowledge. Knowledge is there in all CAs, but the thought process which he has is really very, very enlightening for all the council members. So everyone is always eager to listen whenever his thoughts he brings out. So the new thoughts which are coming to council, that the council is getting benefit. Thank you, Shidaji, for always being very frank and putting your points in the council so that the members and the students all can benefit out of it. And this practical module which the Board of Studies Skill Operations that have done, I feel it is really great because students in their practical training may not be having access to all the fields. Some may be purely into statutory audit, some may be into internal, some into M&A, some into taxation. But having a field of a practical knowledge of all the areas, which as a thought process of the Board of Studies Skills Operations. So that is really remarkable. And all the students who are going through this, listening to this, and even not at the moment, but later on through the videos which are available on the ICI TV, they would all be getting benefit. So thanks a lot for taking this initiative. And this today is the 19th Sunday, 19th program which we are having it. And we have got two speakers. One, CA Dr. Alok Garg, another a very dear friend who is an author on accounting standards and Ind AS, and he has been a regular faculty in the Ind AS course for the ICI and being on various committees of the board. And of course, CA Neha Jain, who would be in working in tandem with Alok Garg to see the various questions and the technical sessions which will be coming out here. Students, let us first of all be very, very clear about one thing. It is that when you do a chartered accountancy course, when you're doing it, it is not merely to have a degree thereof. Even if you don't clear, it hardly matters. But it's the knowledge which you are gaining through this process. None other institute other than the Chartered Accountants in India who's having so much knowledge, so much sharing of the knowledge, which is available free of cost. Free of cost. Go on the DLH, go on the Students Knowledge Center, wherever you go. And these practical programs None other institute I've seen is doing that. So please avail of this. These learnings would be really very helpful in your whole life later on. One thing for which chartered accountants are known for is audits. And we have to be very clear in understanding, though we are going into different areas, maybe direct tax, indirect tax, maybe insolvency, RERA, valuations, so many new areas, even the digital area, entrepreneurship, very fine, very fine. But the base of each and every transaction, I would be saying, are the financial statements, the bookkeeping, the financial statements. And that we chartered accountants should have a knowledge. We students should have a knowledge. We should have the grip. And the basic thing which is important for that is accounting standards. Preparation of the books accounts, whether it is recognition, whether it is measurement, whether it is disclosure, presentation, all in the financial statements have to be done in compliance with the accounting standards. So such is the importance of the accounting standards. And this is one of the main issues which we see, where various, I would say, corporates, non-corporate listed entities, whosoever they are, sometimes even in the smaller entities, they don't emphasize too much on the accounting standards. However, the accounting standards are the backbone of any financial statement. None of the financial statements can be prepared without proper compliance of the accounting standards, because the standards which would be covering today by Alokji, revenue recognition, inventory, all those, whatever is covering the practical aspects out there, that how that is important for preparation of your books accounts and finalization of the financial statements. And if they're not, then how to do an audit thereof. One have to be very clear which accounting standard. There are a number of accounting standards, and we as an accountant, chartered accountants, should be very clear which accounting standards are applicable to whom. It is not that we can pick and choose whatever we want. They are standardized. For example, in case of listed entities or listed companies or the companies whose net worth is more than 250 crores, or they're holding a subsidiary, they cannot follow anything else other than the Ind AS. And Ind AS are notified to the company's accounting standard rules 2015. But companies other than those who are following Ind AS, they have to follow the company's accounting standard rules 2021. There are around 27 standards for the company's accounting standard rules 2021, and around 37 or 39 in the Ind AS. Now, what about the non-corporates, proprietorships, partnerships, LLPs? So which accounting standards? These accounting standards are the accounting standards which are notified by the Institute of Chartered Accountants of India. And the auditors who are auditing these financial statements, they have to ensure that these accounting standards are complied with. It is a duty of the chartered accountant. Because unless he ensures that the accounting standards are complied with, he cannot audit a financial statement. And sometimes there is a thought process that when you are doing an audit of a non-corporate proprietary partnership, say tax audit. When you're doing a tax audit, sometimes we don't have a feel in a mind that there is a requirement to audit a financial statement. But the audit of a financial statement is the primary based on which you are preparing your 3C. So that for that audit, you need to have a financial statement. And for that financial statement, you have to ensure that they are in compliance with the accounting standards. So such is the importance of the accounting standards. Even the Companies Act 2013 for the companies, they have said that financial statements should have been prepared in the true and fair view in compliance of the accounting standards. And in case these financial statements are not prepared in compliance of the accounting standards applicable, then in the financial statements, the management has to disclose. Auditor's duty is separate, but in the financial statement itself, they have to give the reason for the deviation. What is the deviation? What is the reason for the deviation? And the financial impact of that deviation. A simple example I'll talk about is AS15, where in the companies you need to have an actuarial valuation of the long-term employee benefits. And the company doesn't do. So in that case, not only the auditor will have to report in the auditor's report, but in the financial statements also that is to be reported. And sometimes we have seen in the case of non-corporates, The gratuity provision they take as per the income tax act that they will be doing on the cash basis. No. If it is an accrual system of accounting, there is no option. Our AS1 says the three basics concept, one of them is accrual. So if that is following accrual system, it is not on the cash basis. If the management is saying in the notes to accounts that it is on a cash basis, auditor need to qualify that it is not on accrual basis, because the amount of gratuity provision could be material. Could be material. So taking into account all those things, my humble request that whenever you prepare a financial statement during your articleship and later on when you become a chartered accountant, and after becoming chartered accountant, or even if you don't become, you are into industry, you are into practice, you're an entrepreneur, financial statements are the backbone. So while preparing that, kindly ensure that they are accounting standard compliant. That is the theme for today's discussion, which Alok Garg would be and Neha Jain ji would be taking. So have a great learning. These accounting standards are the backbone of not only our institute, not only of the chartered accountants, but the whole of the country and whole of the world. Whole of the world. IFRS is applicable to the countries, more than 160 countries outside India. The convergent portion in India is the Ind AS. So we need to be accounting standard compliant for the preparation of financial statements. Thank you, Sridhar ji, for giving me an opportunity to share my initial views, and all the best to the students for a happy learning, good learning session. Thank you very much, Sridhar ji.
Thank you, Pramod sir, for really putting such valuable words and also enlightening the importance of our accounting standards at the time of preparation. Then is what we can really think about the applicability. And dear student, let me share, in the recent examination, audit paper performance, the major observations were that students are lacking the practical aspects. So this is an area which is need to be improved. So request all the students to focus, kindly use the current session. Both the speakers, I'm sure with their renewed knowledge, can take you through, put forward. At the same time, as Pramod sir told, the digital learning platform has so much of content. Please go through that, because in the recent examination, we have a lot of observation. There are some students who exclusively followed DLH platform using the ICAI content. They have passed not only both the groups, some of them have secured the All India rank. So much content is there. Request all the students to kindly utilize it. So I now request the Alok kindly introduce both the speakers, and let's have a wonderful session for the day. Thank you.
Sridhar sir, just one thing which I another wanted to add into that. You know, apart from accounting standards, all the chartered accountants students should ensure that the financial statements are prepared in accordance with the formats of financial statement which are there. Yes. Which for the companies it is Schedule 3, Division 1, 2, 3. But for the non-corporate, it is the ICAI which has brought this formats.
Yes, sir. Yes, sir.
We should ensure that it is there. It is
yes.
There. Thank you.
Thank you. Alok.
Thank you so much, sir. Thank you so much, Pramod sir, for setting the note of this very important topic of today. So now I would like to welcome our learned speakers for today's session. CA Dr. Alok Kumar Garg, a seasoned professional. He is a member of ICAI as well as qualified company secretary from ICSI. He also holds a diploma in IFRS from ACCA, having a long-standing industry experience of more than 15 years in the field of finance and accounts. He has authored 4 comprehensive books and a prolific speaker, having delivered more than 700 lectures on CARO, Schedule 3, Ind AS, IFRS, IGAP, and auditing standards. Thank you so much, sir, for taking out time for our beloved students for today. I would also like to welcome our session moderator and our next speaker, CA Neha Jain ji. She is also a fellow member of ICAI and having a post-qualification experience of more than 11 years. Apart from ICAI, she is also qualified cost accountant and a qualified DISA professional. Thank you so much, ma'am, for joining us today. Now, in the interest of time, without wasting much of the time, I would like to request Alok sir to please enlighten us with all the practical aspects which our students need to understand while applying accounting standards in the preparation as well as auditing of the financial statements. Over to you, sir.
So first of all, good morning to everyone, and I would like to thank Mr. Pramod Jain ji, Sridhar ji for giving me this opportunity to share my thoughts on the practical aspects related to applicability of AS for finalization and audit of financial statement. I would like to thank the entire committee of Board of Studies and ASB for organizing these sessions. And as Pramod ji has very rightly set the context or theme of this particular session. So first of all, being an accountant, we should have accountability. And when we are saying we should have accountability, so ability to maintain the books of accounts or ability to account something which should be there in the books of accounts, right? And for that, we are having accounting standards. And these accounting standards are used as well as in finalization of books of accounts, as well as in auditing of books of accounts, right? So there are two parts of the entire story. One, on the one side of table, there is management who is preparing the financial statement. On the other side of the table, there are auditors who are giving their opinion on the financial statement, right? So management has to prepare the financial statement according to accounting standards. Auditor has to audit or provide or express an opinion on the true and fair view of the financial statement as per in compliance with the accounting standards, right? So first of all, students, let's talk about why this session is there. The first thing, because you all are doing your articleship, you must have cleared CA Inter or IPCC, and you must have been a CA final student. So while doing the articleship, normally we are more concerned about doing whatever work whatever work has been given to the students or articles. So we are more concerned about doing that work only, right? So in that case, we know how to do that work. But why this work is there, I think that is more important to know, right? You all which gives a practical view of compliances. For example, if there is a difference between depreciation as per Companies Act and depreciation as per Income Tax Act, there is a calculation, there is a formula, there is an Excel file where we used to calculate deferred tax asset or deferred tax liability. But what is deferred tax asset or liability? Why deferred tax asset or liability? It gives it this why will give you a practical view of the compliances, right? It will give you the practical view of compliances. Pramodji said, if your client is preparing the financial statement as per cash basis of accounting, you have to qualify the books of accounts. You have to qualify in your audit report, right? So why accrual concept is important, right? And this deferred tax is one of the important aspect of the accrual concept. So this session will help you in having a practical view of compliances. When I say compliances, of course, compliances relating to compliance of accounting standard, compliances relating to other regulation which is relevant to your client or relevant to that entity, right? For example, if I'm talking about preparation of financial statement, your client is dealing with the MSME entity, right? So MSME Act is again very important from the perspective of recognition of interest due to MSME, right? When there is a payment beyond appointed date, there should be a interest liability on MSME. So interest provision has to be there, right? As per the accrual concept of accounting. And where this accrual concept has been written, the accrual concept is one of the three fundamental principles of accounting as per accounting standard. One, going concern, consistency, accrual, right? So as per MSME Act, you have to create a provision of interest, right? And why you have to create a provision for interest? Because of the accrual basis of accounting, right? Then again, section 22 of MSME Act talks about your 5 disclosure. Although these disclosure are also part of your schedule 3, okay? But for non-corporate entities, now this technical guide on preparation or format of financial statement of non-corporate entity, which has been issued by ICI in June 22, has also given or has also covered the 5 disclosure relating to section 22 of MSME Act, right? What is the principal outstanding? What is the interest outstanding? What amount you has been paid during the year on account of delay payments to the MSME? So these sort of disclosures are there. But the crux of the story is MSME Act is again a very relevant and important from the perspective of preparation and audit of financial statement. For example, there is a interest payment to MSME, right? Do we require to create a deferred tax or do we require to create a current tax? So in that scenario, income tax knowledge is again important, right? So accounting standard are one of the basic fundamental pillar on which entire building block has been has been constructed for the financial statement. So like interest on MSME is disallowed in Income Tax Act. Doesn't matter you are paying or you're not paying, it is disallowed. So interest on MSME is disallowed, right? So in this case, if interest on MSME is disallowed, there is a provision for tax, current tax on that, but no deferred tax will be created on that, right? Second, my second bullet is efficient and effective. So what is meant by efficient and what is meant by effective? For example, the students who are having a knowledge of service tax, right? And they are saying, sir, we were filing service tax returns, we are preparing service tax calculation, and we are very efficient in what we are doing, right? But are you effective as of now? If you have knowledge of service tax only, you are not effective. You may be efficient, but you are not effective. Why? Because there is no service tax as of now. There are GST, right? So you have to be efficient and you have to be effective. And for being effective, you have to be aware about the latest regulation, latest knowledge, latest amendments on different areas which is applicable to the preparation and audit of financial statement. So again, why this practical aspect is very important. If we want to be a bookworm, when I say bookworm, right? So if we only have a bookish knowledge, probably we will not be able to deliver in the true spirit of the profession. Why? Because there are 3 sets of accounting standard prevalent in India. And wherever you are working or wherever you are doing your articleship, your principal or your CA firm would have different set of clients, right? Your CA firm would have a non-corporate entity, for example, sole proprietorship, partnership, trust, association of person, limited liability partnership, right? Hindu undivided family. So your CA firm would have a non-corporate or non-company entities as a client. And there could be a scenario where you need to prepare the financial statement of those clients as a consultant, or you need to audit the financial statement of those non-corporate entities, right? So on these set of entities, accounting standard issued by ICAI is applicable, right? Second, your CA firm would have some clients which are private limited entities, and the net worth of those clients would have been lesser than 250 crores, right? So on those kind of clients or on those kinds of private limited entities, accounting standard notified under Companies AS Rules 2021 is applicable, right? So in the first case, I have told you that accounting standard issued by ICAI are applicable. In the second case, I have told you that accounting standard issued by or notified under Companies AS Rules 2021 is applicable, right? Your CA firm or your workplace would have a client where it is a company, could be a private limited company, where net worth is more than 250 crores, or it could be a listed company, right? It could be a listed company. So on these set of companies, Indian accounting standards are applicable, which is part of the curriculum of CA final as well. In CA final, paper 1 financial reporting, entire Ind AS are covered under paper 1 FR, right? So Indian accounting standard are the converged version of IFRS applicable to India, right? On these set of entities, Ind AS are applicable. So you are part of a firm where different clients are there, where different accounting standards are applicable, different format of financial statements are applicable. You all agree with me, right? And you don't have a choice to say no to your principal. And I would say you don't have to say no to your principal. Why? Because different set of clients would give you a opportunity to learn different things, opportunity to interact with different stakeholders, opportunity to apply your knowledge, opportunity to learn new things on these diversified set of clients, right? So different set of accounting standards are there, and hence only bookish knowledge will not help you. The practical knowledge, your practical aura, your practical ability to apply your bookish knowledge will become very, very, very important, right? This 3 years of articleship, or whatever 3.5 years of articleship, would allow or would give you enough opportunity or platform to apply your knowledge, right? So then coming to the fifth step or fifth bullet, format of financial statement. In India, we have a different format of financial statement for different set of entities. For example, if I talk about companies, right? So division 1 to schedule 3 is applicable. Division 2 to schedule 3 is applicable. Division 3 to schedule 3 is applicable. Now, if you have only a bookish knowledge, when you Google out schedule 3, so probably the schedule 3 which is thrown by Google will not satisfy your requirement, or would not be in compliant with the client for which you are maintaining the accounts, or you are finalizing the accounts and auditing the accounts, right? So division 1 to schedule 3 is applicable to the companies. I'm emphasizing the word companies, corporates, right? It is applicable to the companies on which accounting standards are applicable. Which accounting standard? AS notified under Companies AS Rules 2021. And I would request students who are watching this session on a live basis, please be ready with your pen and paper. And I would request all of you to please note down some important points as well, right? So division 1 to schedule 3 talks about format for preparation and presentation of financial statements, and it is applicable to the companies on which AS is applicable. Coming to the division 2 to schedule 3 is again a format for preparation and presentation of financial statement, and it is applicable to the companies on which Ind AS are applicable. Indian accounting standards are applicable, right? Division 3 to schedule 3 is again applicable to the companies. Which companies? NBFC companies. Division 3 to schedule 3 is again a format for preparation and presentation of financial statement, and it is applicable to the NBFC companies on which Ind AS are applicable. Now the question comes, sir, you talked about schedule 3, division 1 AS companies, division 2 Ind AS companies, right? Division 3 NBFC Ind AS companies. Sir, if there is a NBFC companies on which accounting standards are applicable, why? Because the net worth is less than 250 crores. Can we apply division 3 to schedule 3? Answer is no. You cannot apply division 3 to schedule 3. You have to apply division 1 to schedule 3, because this division 3 to schedule 3 has been prepared in compliance with Indian accounting standards, right? Understood? So you have to understand, you have to be aware that there are a lot of difference between the words, terminologies, recognition condition, measurement condition under accounting standard and under Indian accounting standard. For example, under accounting standard, the word minority interest have been used. Under Indian accounting standard, the word non-controlling interest have been used. These two words are not simple words, right? So let's say if I'm only referring my book, if I am a student, so probably I will just do a ratification that yes, oh, minority interest is there. Minority interest is there in accounting standard 21, right? In Ind AS 110 on consolidation, non-controlling interest word would be there. But the point is, there is a lot of difference between non-controlling interest and minority interest, right? Minority means something which is less than major, right? Less than 50%. Non-controlling, this word has a meaning. Why word non-controlling interest has been used in Indian accounting standard? And I would request each one of you to start raising the question why. This why is very important while doing a compliances, while checking the compliances, and while ensuring the compliances, right? So why non-controlling interest word has been used? Because in Indian accounting standard, the concept is de facto control, right? The concept is, even for example, Ambani family holds 40% in Reliance Industry, and the 60% shareholders are fragmented, okay, separated. Like I am holding 5 shares, Neha is holding 15 shares, Mr. Alok Jha is holding, let's say, 20 shares, Pramod ji is holding 50 shares, Sridhar ji is holding 100 shares, right? So fragmented shareholding is there. So in this case, probably this 40% shareholder will control this entire company, right? So non-controlling interest means even though there could be a majority shareholder, but he could be a non-controlling interest, right? So this 60% shareholder would be a non-controlling interest, right? So the concept of non-controlling is there. I'm not dwelling into the concept in detail, but the moral of the story is you have to see what terminologies have been used, why these have been used. It will give you a practical aspect out of it, right? Again, coming about current and non-current classification, right? So I was talking about the format of financial statement, and I have told you that three divisions are there, which is for companies. For non-company entities or for non-corporate entities, the format is recently published by ICAI, and that is a format of financial statement for non-corporate entities, right? This format will bring in harmony. This format will bring a consistency, and this format will bring a governance, right? When every company will follow that format, so the financial statement will be comparable from one client to another client, right? Or the companies or the CA firms, I'm not talking about companies, chartered accountancy firm would have a standardized format for their non-corporate clients as well, right? So this was the agenda of the session, right? And our session is more from the perspective of applicability of accounting standard for finalization and audit of financial statement, right? So now let me discuss this slide, which I have discussed you, that your principal is having these 7 clients, right? So first of all, you need to understand what compliances are applicable to us. For example, there is a client name as a Ramlal and Sons, and it is a partnership firm. So on this partnership, which financial statement is applicable? On this partnership, technical guide or the format of financial statement issued by ICAI is applicable, right? So ICAI format on financial statement which have been issued in June 22 is applicable, right? Which accounting standards or Ind AS is applicable? I have told you 3 sets. Pramod ji has also highlighted 3 sets of accounting standard, right? AS issued by ICAI, AS issued by Companies Act MCA, Ind AS issued under Companies Ind AS Rules 2015, right? So which accounting standards are applicable? AS issued by ICAI are applicable. AS issued by ICAI are applicable. Ramlal India Private Limited, net worth less than 250 crores. Ramlal India Private Limited company, which format of financial statement are applicable? I have just discussed. You can respond on that. If you are watching live on YouTube, you can respond on the comment box, right? But what format of financial statement is applicable? Division 1 to Schedule 3. Division 1 to Schedule 3. And this Schedule 3 is part of Companies Act, right? Part of Companies Act. Division 3 to Schedule 3, which was issued on 24th March 2014 and as amended by 11 October 2018 and 24 March 21. So Division 1 to Schedule 3 is applicable for the format of financial statement. Which standard is applicable? AS or Ind AS? Yes, accounting standards are applicable. Which AS? AS issued or AS notified under Companies AS Rules 2021. Companies AS Rules 2021, right? Shyamlal India Private Limited, net worth more than 250 crores. The net worth is more than 250 crores. Which format of financial statement is applicable? Division 2 to Schedule 3. Division 2 to Schedule 3. And I would request all students that wherever you are doing the articleship, on the top side of this table, so please on the paper write down the name of your CA firm, and these are the clients, these are your clients where you have to work. Okay, these are the clients where you have to audit or you have to prepare the financial statement for these clients, right? So Division 2 to Schedule 3 is applicable as far as format of the financial statement is concerned. Which AS or Ind AS? Ind AS is applicable here. Ind AS is applicable here, right? So Ind AS. Which Ind AS? Ind AS notified under Companies Ind AS Rules 2015. Sohanlal Leasing Private Limited, NBFC company, other than 250 crores, right? Less than 250 crores net worth. Net worth is less than 250. When I'm saying less than 250, I'm talking about net worth. Okay, net worth less than 250 crores. Sohanlal Leasing Private Limited, NBFC company. Which division, which format of financial statement is applicable? Division 1 to Schedule 3 is applicable. Division 1 to Schedule 3, right? Which accounting standard? AS issued or notified under Companies AS Rules 2021. Mohanlal Leasing Private Limited net worth is more than 250 crores. NBFC company net worth more than 250 crores. Which format of financial statement is applicable? Division 3 to Schedule 3. Division 3 to Schedule 3 is applicable. And Indian accounting standards are applicable. Ind AS are applicable, right? Rohanlal Bank Limited, there is a bank and you are the auditor of that bank. So which format will be applicable? Generally, these banks will follow Division 1 to Schedule 3. Division 1 to Schedule 3. And these banks are following accounting standards, right? On banks, Ind AS is not applicable. Doesn't matter that bank is a listed company or not a listed company. State Bank of India, HDFC Limited, HDFC Bank Limited, ICICI Bank Limited. On these set of banks, Ind AS are not applicable. On banks, Ind AS are not applicable. Lakshman Insurance Company Limited. Again, Division 1 will be applicable and accounting standards will be applicable, right? Division 1 to Schedule 3 is applicable. So friends, I hope you guys are clear about different format of financial statement. As of now, we have 4 format of financial statement. One is given by ICAI for non-corporate entities. I'll show you that format because our agenda is preparation and audit of financial statement, right? Then there is a Division 1 to Schedule 3 in Companies Act, which is for AS companies. Division 2 to Schedule 3 for Ind AS companies. Division 3 to Schedule 3 for Ind AS NBFC companies, right? So accounting standard issued by ICAI for non-corporate entities, accounting standard notified under Companies AS Rules 2021 for companies on which AS is applicable, and Indian accounting standard notified under Companies Ind AS Rules 2015 applicable to the companies on which Ind AS are applicable, right? So now you are having a umbrella concept or umbrella view of applicability in terms of format of financial statement, applicability in terms of AS, applicability in terms of Ind AS, right? So now, since this session is a practical session and I don't have to just show you the paras of accounting standard or the accounting standard, I have to talk very practically, right? Which will help you in performing the audit, in doing your work, right? So coming to this thing, my question to you guys is, and I would request you to please answer this question to yourself only, right? Because this is one-way communication. And if you have any question, you can just send your question to ICAI on the chat box or on the text box, whatever is given to you, right? And at the end of the session, I would be happy to take all those questions, right? So first of all, preparation of financial statement. For example, I'm the auditor of the company, and in my CA firm, we are the auditors, right? And I am going to the client in terms of the auditor, right? So the first question which lies, that preparation of financial statement, who is responsible? Your client or auditor? Management or auditor? Who is responsible? Preparation of financial statement is the responsibility of the management, responsibility of the client. But auditors are responsible to provide, to express an opinion on the true and fair view of the financial statement. Auditor has to provide an opinion where the management, the entity, the client has complied with all the accounting standard or not, has complied with all the accounting standard or not, right? And let me show you one thing. If you see, there is a preface to the statement of accounting standard. Apart from requirement to comply with accounting standard, apart from requirement to comply with the accounting standard, as may be prescribed in the relevant standard. So relevant standard talks about the application of accounting standard, right? But apart from the requirement to comply with AS as per the relevant standards, there is a preface to the statement of accounting standard which ICAI has issued, and it lays down some principles. And I am reproducing one very important principle, right? The accounting standard will be mandatory from the respective dates mentioned in the accounting standards. For example, if I talk about AS2, valuation of inventory, this standard was issued in 1983 or 1984, right? So AS2 was applicable from that date, right? The mandatory status of the AS implies that while discharging their attest functions, it will be the duty of the member of the ICAI. What attest function? When you are auditing or when you're attesting the financial statement, right? So it is talking about the auditors. When you are attesting or certifying or giving an audit report to the financial statement, the member of the institute, I mean to say chartered accountant, auditor, has to examine whether the AS is complied with in the presentation of financial statement covered by their audit or not. So auditor's responsibility is to examine whether AS has been followed or has not been followed, right? So first question comes into the mind, sir, we do have a knowledge of accounting standard. The second question, when we do have a knowledge of accounting standard, how we apply our knowledge in auditing the financial statement, how we apply our knowledge in application of the accounting standard. And let me give you a very good example for that, right? Let me give you a very good example for that. For example, if you read para number 23 of accounting standard 1, you are not required to remember para number, you are required to remember the concept. When you see para number 23 of accounting standard 1, it talks about that disclosure of a wrong accounting principle. Disclosure of a wrong accounting principle, wrong accounting policy. Disclosure of a wrong accounting policy is not a remedy of application of wrong treatment or wrong accounting policy. मतलब अगर आपने गलत accounting treatment करके disclose कर दिया है तो आपका वो remedy नहीं है. Auditor cannot say that your financial statements are complying with the accounting standards. He has to qualify. He has to say these financial statements are not complied with the accounting standard. Disclosure is not a remedy. Disclosure is not a vaccination. Disclosure is only an intimation. Okay, it is only an intimation. Understood? So, and I can give you a classic case of this. I have seen a client, right, where so there was a small CA firm and the third year article was there, right? So normally when you go on audit, you are representing your CA firm, right? And whenever there is a small client, so you guys are directly dealing with the chief accountant or owner of that entity, right? And he is taking the advice from you guys as well, right? And I think this is a very, very simple thing and very basic thing which I'm telling you all guys, right? So he is not reaching to your boss who is principal. Probably, with 1 or 2 years of engagement, he is more comfortable with you guys, and he is seeking or asking advice from you guys only. So one of the sole proprietorship firm or partnership firm has asked an article who was third year article, that I want to increase my profit, right? So what should I do? So when they were debating on, or when that article or owner was discussing about the accounting treatment, so he said, I can do one thing. The owner said, I can do one thing. What I can do, I can just change the valuation of inventory, right? So accounting standard 2 says that inventory has to be valued at cost or NRV, whichever is lower, and for measuring the cost, you have to apply FIFO method or weighted average method, right? So FIFO or weighted average method is allowed only. So owner said, my last purchases are at a higher price. So let me go through with the LIFO method of accounting, last in, or let's say it is at a lower price. So let me go through the last in first out LIFO method of accounting. Okay. And by that, my inventory valuation will get higher, right? And accordingly, I will have a higher profit. So article says that, but sir, this LIFO method is not allowed in accounting standard, right? So he was only having, in view of AS2, right? Because AS2 talks about inventory. And let me tell you, while preparing or while auditing any financial statement, you don't have to see a particular accounting standard in isolation. You have to see the accounting standard while applying the rule of harmonious construction and while thinking universally, right? So he said, sir, LIFO method is not allowed. Then the owner said, doesn't matter. just if you want to disclose this in the notes to the financial statement, you can disclose. इसको disclose कर दो और disclose करने से अपना काम खत्म हो जाएगा. हम disclose तो कर ही दिया हमने. So AS2 only gives these two information, that FIFO and weighted average. It does not talks about LIFO method. It is prohibited, although LIFO method is prohibited. But AS1 talks about that disclosure of wrong accounting policy is not a remedy for application of a wrong accounting policy, right? So the third year article, he forgot about that. Yes, this concept was also there in accounting standard 1. In spite of the fact that we are applying a wrong accounting treatment and disclosing it, it does not protect us from giving the tag of non-compliance with accounting standard, right? So guys, you have to remember about para 23 of AS1. When you read it theoretically, you think that you thought that, oh, this is a very theoretical kind of para, right? It is not theoretical, it is very practical paragraph, very practical. I can give you one more example, and this example is from Indian accounting standard. Ind AS 1 talks about presentation of financial statement, right? There is a para number 12 of Ind AS 1, and that para number 12 talks about that equal prominence has to be given to all the component of the financial statement. आपको फाइनेंशियल स्टेटमेंट के सारे कंपोनेंट को इक्वल प्रोमिनेंस देनी है. इक्वल प्रोमिनेंस देनी है मतलब आपको पूरी सेम तवज्जो देनी है सारे फाइनेंशियल स्टेटमेंट के फॉर्मेट को, कंपोनेंट को, राइट? सो जस्ट लास्ट टू लास्ट वीक व्हेन आई वाज डिलीवरिंग माय सेशन इन गोरखपुर, तो वन ऑफ द ऑडियंस आस्क्ड मी, सर, while doing the rounding off in the financial statement, can we remove the decimals in balance sheet, P&L and cash flow, and can we provide the numbers in notes to accounts into the decimals? So guys, normally what I hear from the Ind AS members or Ind AS students, they said that, sir, this para 12 does not have any meaning, right? It said that equal prominence has to be given to all the component of the financial statement. Guys, it has a great meaning in preparation of financial statement. It says that you cannot give less weightage to the notes to accounts and you cannot give more weightage to the balance sheet. Each component is having an equal weightage, right? And this is written in para number 12 of Ind AS 1, right? So my point of way or my thing to talk this thing here is, whenever you are reading accounting standard, whenever you are applying accounting standard, think practically where it is being used, why this paragraph has been introduced, right? And when you are doing a practical application by thinking why, let me tell you, you are not required to do any revision for your examination, right? It will be remembered by heart. Let me tell you, it will be remembered by heart, right? So if you see this preface to the statement of accounting standard, even the preface says that the member of the ICI who is an auditor has to examine whether the financial statement is AS compliant or not, right? In their audit, in the event of any deviation from AS, for example, you will say that, sir, my client is not ready to comply. My client is not ready to comply with the accounting standard. What can we do? In that case, if you are attesting the financial statement, if you are issuing an audit report to the financial statement, you have to put a qualification and disclosure in an audit report that the XYZ Private Limited or XYZ and Sons has not complied with the accounting standard and there is a deviation of AS1 or AS2 or AS5, whatever it may be, right? So the first thing is, who is responsible for the preparation of financial statement? Of course, management is responsible, but yes, auditor is also responsible to examine, to ensure that it should be AS compliant. And if it is not AS compliant, auditor has to mention this fact in the notes to accounts. Auditor has to mention this fact in the notes to accounts. I hope it is clear to everyone. My question to you guys is, what is the element of financial statement? What are the elements of financial statement? I think I am getting balance sheet, P&L, cash flow. Few of the students must have been writing balance sheet is one of the element, cash flow, P&L, notes to accounts, right? Wrong. When I'm talking about element of the financial statement, there are 3 elements to the balance sheet and 2 elements of the P&L. So globally, these 5 elements are there, Panch Tattva of financial statement. asset, liability, equity. Asset is a resource, liability is an obligation, equity is a residual interest, partners capital, corpus, capital fund, right? So equity, share capital, these are the equity, right? Income and expense, right? So these are the five: income and expenditure. These are the five elements of the financial statement. What are the component of the financial statement? What are the component of the financial statement? If I'm talking about the AS compliant entities, accounting standard compliant entities, balance sheet, profit and loss, statement of cash flows, and notes to accounts and other explanatory information. If I talk about Ind AS compliant companies, right? In your firm, you do have an Ind AS client as well. So balance sheet, profit and loss, cash flow statement, notes to accounts, and other explanatory information. These four are common. But under Ind AS financial statement, there is one more component, and the name of the component is statement of changes in equity. Statement of changes in equity. What is statement of changes in equity? It is the reconciliation of share capital and reserves and surplus. Okay. Next part, current or non-current classification. Are we required to do current and non-current classification? Answer is yes. As per the new format given by ICAI for non-corporate entities, and as per Schedule 3, this current non-current classification is mandatory requirement. Current non-current classification. Now, what is current and what is non-current? Right. First, in accounting standard, current and non-current is not defined in accounting standard. In Ind AS, current and non-current is defined, but current and non-current is defined under Schedule 3. Current and non-current is defined in the technical guide which is issued by ICAI on the preparation and presentation of financial statement. I mean to say format of financial statements. So while practically doing the audit, and I have seen some students or some articles, what mistakes they are committing or they have committed while classifying a particular item into current and non-current category. They are just looking at the past. For example, there is a debtor, right? And the debtor has not paid to the company for last 1.5 years. I'm just taking an example. So the article or the trainee will say that, sir, you haven't received the money in last 1.5 years. So there is no point to keep this item into current category. You have to keep this item into the non-current category. So the first thing, when you are talking about current and non-current on the balance sheet date, you have to think about future. You don't have to think about the past. This current and non-current classification is more from the future perspective, right? Sitting on the balance sheet date on 31st March 2022, you have to analyze whether I'm supposed to receive this money. I expect to realize this money in the next 12 months from the reporting date. If your answer is yes, then it is current. If your answer is no, then it is non-current, right? Whether I will receive the money during the operating cycle. If your answer is yes, it is current. If your answer is no, it is non-current. Same lies with liability. Am I paying, or am I supposed to pay, or will I pay this liability within 1 year from the reporting date? If your answer is yes, you will have to categorize this item as a current, otherwise it is non-current, right? Regarding liability, you are required to see whether the company has a unconditional right to defer the settlement. For example, there is a creditor, right? There is no contract that I will pay you after 1 year. So tomorrow, if the creditor will come and ask money, can I deny him? Can I say him that no, I'll not pay you within 1 year, I'll pay you after 1 year? Can I say that? Answer is no, I cannot say that, right? So it will always be current. It will be current. Okay. So basically, you have to see all these facts while classifying current and non-current, right? So current and non-current is not, it's not a very simple classification. It requires some judgment. It requires some diligence. It requires your application of mind as well, right? So it's not like that whatever was current, whatever was non-current in the last year, it will be non-current in the current year as well. Okay, so this will not be the case. For example, there was a fixed deposit which has been made by the company, which is deposited by the company on, let's say, 31st January 2022 for 2 years. For 2 years, right? So the maturity date is 31st January 2024. The company is preparing a balance sheet on 31st March 22. In this balance sheet, this FD will be non-current. This FD will be non-current, right? On 31st March 23, on 31st March 23, whether this FD will be non-current or this FD will be current. In 31st March 23, this FD will be current, right? Why? Because on the balance sheet date, the remaining period, this FD has to be matured within a period of 12 months, right? So it has to be current. So guys, when you are giving comparative, doesn't matter that whatever was non-current in the last year, it will be shown as a non-current in this year only, right? Or a vice versa. Okay. So now let's move to the next bucket, which I think it's a very practical part. So whether while preparing accounting standard, right? Whether while preparing the financial statement, we need to apply only accounting standard or we need to look at other regulation as well. When I'm talking about other regulation, I'm talking about Companies Act. I'm talking about SEBI regulation for listed companies, right? I'm talking about banking. I'm talking about banking regulation, right? For example, our accounting standard 18 says that if there are transactions with related parties who is KMP, key managerial personnel, please try to understand this thing. Accounting standard 18 talks about related party disclosures, right? Accounting standard 18 also talks about that if there is a transaction with related party who is a KMP, key managerial personnel, for example, director of the bank, MD of the bank. So the transaction with KMP is also required to be disclosed. Now, para 4 or para 5 of AS 18, para 4 or para 5 of AS 18 talks about that if disclosure with related party like KMP is conflicting with the confidentiality requirement of any act, for example, Banking Regulation Act, RBI Act says that if the bank has done any transaction with the customer, that customer transaction will not be disclosed in the notes to accounts or will not be disclosed in the financial statement, right? So guys, in this case, if you're only referring to accounting standard, although in para 4 and 5 this thing has been given, and in para 4 and 5 only this thing has been given, that if it is breaching the confidentiality requirement of any regulation, then you are not supposed to disclose. So first thing, you have to see that particular regulation, right? For example, on banking company, the RBI regulation play a very important role. So you have to see that. Practically, and I would say each one of you that please download State Bank of India annual report. Please download State Bank of India annual report for 21-22. When you download State Bank of India annual report for 21-22, then go to the related party disclosure. There you find that they have mentioned that we are having a transaction with our KMPs in terms of a customer or as a customer, and hence we have not disclosed the transaction with our KMPs as a customer. They have mentioned this fact. Okay. And I can tell you 99% of the students, 99, please mind my word, the number is 99. 99% of the students are not practically applying these aspects while doing the audit or while preparing the financial statement, right? Their principal advises them that you need to see these kind of things, right? So guys, whenever you read the accounting standard, take the opportunity of practical applicability of those accounting standards while performing the audit, while preparing the financial statement, right? Just relate what is applicable to this client, what sort of disclosures are required, what accounting standard says, and then apply it practically. It gives you a lot of comfort. It gives you a lot of confidence. It gives you a lot of knowledge, right? So that is one aspect of it. Second, MSME, Micro, Small and Medium Enterprises Act 2006. I have told you lot of disclosure regarding MSME is required. On the face of the balance sheet, you are required to disclose trade payable related to MSME entities, related to other entities, right? Then your 5 disclosure as per section 22 of MSME Act is also required to be made. Interest recognition is also required to be made for the delay payment of MSME, right? So Income Tax Act is again important. Why it is important? For example, provision for gratuity. So provision for gratuity is disallowed in income tax and allowed on the basis of payment. First thing, going by the accrual concept, you have to create a recognition, you have to recognize provision for gratuity provision, right? Second, since it is a timing difference, so when you provide, it is disallowed. When you pay, it is allowed in income tax, right? So deferred tax calculation will be there on this provision for gratuity, right? So not only accounting standard, related regulation. Please, I am emphasizing the word related regulation. In India, there are more than 1,000 regulations. So you cannot see every regulation, but whatever is applicable to you, you have to see that. Understood? Clear? Comparative. Now, question comes, sir, do we need to provide comparative only in the balance sheet, only in the profit and loss, only in the cash flow statement, or in the entire set of financial statement? I have told you, component of financial statement means balance sheet, profit and loss, statement of cash flows, and notes to accounts and other explanatory information. Now it is again, notes to accounts is an integral part of the financial statement. It is an integral part of the financial statement. So friends, the comparative has to be given in the notes to accounts as well. Wherever the numbers are there, wherever the numbers in the current year are there, the numbers for previous year is also required to be presented and disclosed, right? So comparative has to be there, not only in balance sheet, but in the entire component or entire set of financial statement. Very important question. And normally when I ask this question to the students, 60 or 70% times I got a wrong answer. For example, your principal has sent you for the audit of a client. So of course you will go after 31st March 22, right? So the balance sheet has to be prepared for that company for 21-22, which is ending on, which has been ended on 31st March 2022. And you went to that client in May 2022, right? And the balance sheet and financial statements got signed in August 2022. 31 मार्च 22 की बैलेंस शीट है, आप ऑडिट पे अप्रैल या मई में गए, और फाइनेंशियल स्टेटमेंट जो साइन हुए, ऑडिट रिपोर्ट जो साइन हुई, वो हुई अगस्त महीने में, अगस्त 22 में. टू बी प्रिसाइज, लेट्स से 20th August 2022. Now the question arises, whether you are required to perform the audit, whether you are required to see the events only till the reporting date, I mean to say 31st March 2022, or till the financial signing date, which is 20th August 2022. Tell me, what is your view? And let me give you one more perspective to this. On 31st March 2022, your client was a non-corporate client, your client was a partnership firm, okay? And in the month of July 2022, there was major fire in the godown of your client. There was major fire. Due to the fire, going concern was impacted. Going concern was impacted. Now the question arises, are we required to see the events or facts till 31st March 22, or are we required to see the events or facts till 22nd August 2022? So the answer is, you have to see the subsequent events as per accounting standard 4. Adjusting event, non-adjusting event, you have to see the subsequent event till the date of signing of your financial statement, and that subsequent event is from the reporting date to the date of signing of the financial statement, right? So in this case, if there is a major impact on the going concern, you have to do the necessary adjustments. You have to do the necessary disclosure in your financial statements, right? So these events are not only till the reporting date, it is till the financial statement signing date, right? You have to see the subsequent events, right? Next aspect, the client is not agreeing. No, I'll do only this kind of accounting treatment. And that is not covered under accounting standard. That is not supported by the accounting standard. Whether disclosure is enough, because I have seen many chartered accountants and many senior articles are providing or guiding or giving the advice, such kind of advice to the clients. Is it tenable? This is not tenable, right? So disclosure is not a remedy, it is an information, right? It is an information. So disclosure is not a remedy. Disclosure of wrong accounting policy is not a remedy for application of wrong accounting policy, right? Para number 23, accounting standard 1. First accounting standard, smallest accounting standard, basic accounting standard, right? Letter of representation. Sir, when we go to the client, we used to sign the balance sheet, we used to sign the financial statement, sir, and client says so many things. Client says so many things because we were inquiring why you have not created a provision for debtors, right? You are not getting the money for the last 2 years, for the last 3 years. Why you are not creating a provision for bad debt? So he's saying, no, this client is a good client, good money, right? So there is no requirement for a provision for bad debt. And the same client in the next year, when the profit were huge, when there is high profit, the client is creating a bad debt for that provision, bad debt for that customer, right? Now the question arises, do we need to rely on the verbal story given by the client, or do we need to ask something which is into writing? So we have to ask something which is in writing. And when I say in writing, I mean to say you have to ask for the letter of representation, LOR, management representation letter, where the client has to put all these facts, the client has to put all these narratives, okay, and it has to be given to you while signing the financial statements, okay. I hope it is clear to all of you. So friends, letter of representation is again very important to be taken from the client, that whatever client is advising you, whatever client is explaining you, it has to be well supported with the audit evidence, right? So we talked about this letter of representation. Confirmations, in external or internal. I have seen a very classic word, while, and you must have seen that, and even I have seen that. So some of my friends who are practicing chartered accountant, they said that while articles are preparing the financial statement, what they are doing in inventory, normally what word is getting used? As valued and certified by the management. Inventory, as valued and certified by the management. Is it a right word? This is not a right thing. So if you have got this thing written on the balance sheet, I mean to say written on the notes to accounts, that inventory as valued and certified by the management does not give you any protection, right? The entire balance sheet is the responsibility of the management. Why only inventory? Why not PP? Why you are not getting this written on every line item on the financial statement? Why only inventory? These financial statements have been signed by the management also, and management is responsible for the preparation of financial statement. So it doesn't matter whether you are writing this thing categorically or you are not writing this thing categorically, right? So the question arises, sir, are we free from our responsibility of auditing when I'll write these 3 golden letters, write 3, 4, 5 golden letters, or write 1 golden line? Answer is no. The first thing which auditing standard also said, you have to rely more on the external evidence rather than internal evidence. You have to ask, where is the valuation report? Where is the calculation? You have to do the physical verification of inventory, right? So you have to do all this sort of, due diligence. You have to do all this sort of audit while doing these things, right? So while auditing the financial statement, you have to rely more on the external confirmation rather than internal confirmation. For example, you are auditing the salary expense. Ask for provident fund challans, right? Whatever you have deposited in provident fund. So whether you will, if you will divide by 12%, whether it will give you the basic salary. So you have to inquire in that manner. You have to ask for the bank confirmations directly from the bank, not from the client, right? You have to write a letter to the bank seeking the external confirmations, right? For your current account, I mean to say client's current account, client's OD limits, CC limit, loans, borrowings, right? You have to write the direct confirmation to the creditors, debtors, right? Regarding the verification of the balances. So you have to rely more on external rather than internal. I would not say you don't have to rely on internal thing. You have to rely on external things as well. You have to give more emphasis, more weightage to the external things, right? Is it clear? Yeah. So we talked a lot about the practical approach and practical aspect in our day-to-day life while preparation or presentation of financial statement. Okay. Right. Now, so if I talk about a quantum, around 60 to 70% of the article trainee are doing the article say from mediocre or less than mediocre firm, right? Small firms. So when they are doing their article say from small or mediocre firms, they do have, you know, non-corporate clients. And when they do have non-corporate clients, right? In that case, these small non-corporate clients are not much concerned about compliance of accounting standards, right? First reason why? Because they don't have the appropriate resources. For example, there is a sole proprietorship firm, there is a Kirana store, right? So there is a one-man army for that Kirana store, right? And he is maintaining his books of accounts on tally, and he is putting accounting entry at his own, or probably the one article from CA firm is putting the accounting entries. So he is not aware about the accounting standard compliance. He is a person who is 9th pass out, 9th or 10th pass out. He know how to make money, but he don't know how to make books of accounts, and is not hiring anyone else except the person who used to entertain the customer, who used to manage the business, right? That is the first reason that these non-corporate clients or non-corporate entities are not maintaining the compliances. Second aspect to it, we, the chartered accountant, either the already output chartered accountant, I mean to say whether the fellow member of chartered accountant or whether we are future chartered accountant, I mean to say articles, we also are not eager to learn more on accounting standard or to comply on accounting standard. I think where you got such a client, to me, there is more opportunity to make that client aware. If the client don't want to get aware, of course, you have a more opportunity to implement the compliance of accounting standard on that client. And here, the ownership and responsibility comes more on your shoulders, right? So friends, on 31st March 2021, ICAI has come up with an announcement. And in non-corporate entities, there are 4 kind of entities: large, medium, small, and micro, right? So while doing the audit, while having a client, you have to see, my client is a large entity, my client is a medium entity, small entity, or a micro entity. What is the turnover of my client? If my client is having a turnover of more than 250 crores and borrowing at any time during the period more than 50 crores, then it is level 1 client. And on the level 1 client, all the accounting standards are applicable. How many accounting standards are there? There are 27 accounting standards, and all the 27 accounting standards are applicable to your client. And when I say all the accounting standards are applicable, it means all the principle of accounting standard. There are 4 principles of the accounting and accounting standard. The first one is recognition. The second one is measurement. The third one is presentation, and the fourth one is disclosure. RMPD, recognition, measurement, presentation, disclosure. What is meant by recognition? Recognition means to recognize something. For example, I am having a mobile. So whether this mobile phone has to be recognized as property, plant and equipment, or whether this mobile phone has to be expensed off, right? So this is known as recognition. Once you decided to recognize anything in the books of accounts, then what you will require? You will require a value. You will require a value. Value means how to measure, right? So value means at what value you are required to measure that item in the books of accounts. So the second one is measurement, right? For example, if you read Accounting Standard 10, Standard on Property, Plant and Equipment, it talks about the recognition condition of property, plant and equipment. It says that an item of property, plant and equipment will be recognized if two conditions are satisfied. One, future economic benefit is probable and cost can be measured reliably. Future economic benefit is probable and cost can be measured reliably. For example, your client has purchased a machine, right? Normally what we are doing, we are not giving any importance to these two things, right? Although we are giving importance to the cost because this is something on which we are required to measure, right? But whether future economic benefit is probable, not probable, we are not having any dialogue with our client. For example, your client is a partnership firm and he has purchased a machinery from China. When he got the machinery in his factory, the output which is getting produced from that machinery, the output got banned in India. I'm just taking a hypothetical example. जो आउटपुट उस मशीन को प्रोड्यूस करना था वो गवर्नमेंट ने बैन कर दिया. Can you say that future economic benefit is probable? You cannot say that future economic benefit is probable. So first thing first, just thinking practically, applying it practically, you are not required to recognize that item as a property, plant and equipment because it is not meeting the first recognition condition which is given in Accounting Standard 10. The second condition is meeting. Cost can be measured reliably. Of course, you have purchased, you have paid, you know the cost, right? So this item should not be recognized as a fixed asset, as a tangible asset, as a property, plant and equipment. Rather, this item has to be expensed off in the books of accounts. Second, so this was a recognition condition as per AS 10. Second, measurement condition. If I talk about measurement condition, so measurement condition AS 10 says that once you recognize a property, plant and equipment, you have to recognize this as at cost, right? And then the formula for cost has been given in the standard. So guys, today onwards, when you go to your client, just think and ask, if you have recognized something as a fixed asset, what is the future economic benefit which is probable to the entity, right? For example, if there is a building, of course, the client is maintaining its office, go down in the building, and hence this building is giving a future economic benefit. If the client is maintaining a factory in the building, of course, the production is there. The client has a machinery, of course, the machinery will give the output. The client has a vehicle, lorry, the client has a truck. So this truck the truck will provide future economic benefit in terms of transportation of goods. The client is having a computer. It is giving a future economic benefit in terms of maintaining the books of accounts, right? So the future economic benefit does not mean the generation of revenue only. It also requires to support the business. It works as an administrative thing also, right? So for example, furniture, chair, table. If the chair, table would not be there, the employee would not be able to sit properly and will not be able to perform, right? So these are the example of future economic benefits. So guys, on accounting standard on level 1 entities, all the accounting standards are applicable completely. Okay, which are medium level entities? Medium level entities are those entities where net worth is more than turnover is more than 50 crore but less than 250 crores, and borrowings is more than 10 crores but less than 50 crores. On the medium level entities, out of 27 accounting standard, 7 accounting standards are completely not applicable. So it means if you are an auditor of a medium level entities, only 20 accounting standards are applicable. 20, right? So the 7 accounting standards are not applicable. So you are allowed to not complying with those 7 accounting standards. I will tell you what are those 7 accounting standards. But you have to comply completely with 20 accounting standards, provided some disclosure exemption is given in those 20 accounting standards as well. If I talk about level 3 entity with small entities, and these entities are having a turnover of more than 10 crore but does not exceed 50 crores, okay, and the borrowing exceeds 2 crore but does not exceed 10 crore. On these set of entities, out of 27 accounting standards, 9 accounting standards are not applicable. It means only 18 accounting standards are applicable. Then the last one is micro entities, very small entities, micro entities. And these entities are having a turnover of less than 10 crore. And these entities are having a borrowing of less than 2 crores. Right? On these accounting standards, on these entities, 11 accounting standards are not applicable. What does it mean? It means only 16 accounting standards are applicable. On level 1, all the 27 AS are applicable. On level 2, 20 AS are applicable. On level 3, 18 AS are applicable. On level 4, 16 AS are applicable. 16 accounting standards are applicable, right? So friends, if I talk about accounting standard 1, so it talks about disclosure of accounting policies. And in disclosure of accounting policies, let me show you one very important chart. If you see this diagram, and this diagram is not mine, this is issued by Financial Reporting Review Board. And you can see that there is a 84% non-compliance. 84% non-compliance in 2 paras, para number 24 and para number 25 of AS1. Para number 24 and para number 25 of AS1, right? And I can tell you the AS1 was the first standard. AS1 is the smallest standard. AS1 is the fundamental standard. AS1 is the basic standard. Can you imagine? Out of the overall non-compliances in this particular standard, 84% non-compliances is only relating to 2 paras, para 24 and para 25. And I want to emphasize this particular AS1, right? Because I cannot teach you all the accounting standards in this 2-hour session or 1.5-hour session, right? But this is the first standard which is very important from the preparation of and presentation of financial statement perspective, right? This is very important standard. And if you read para number 24 and 25, it says that all the significant accounting policies are required to be disclosed. What para number 24 says that? It says that the accounting policy for all the material items are required to be disclosed, right? And even I have seen with my 15 years of experience, I have seen that normally the articles, okay, or I would not only say article, normally even the fresher chartered accountant, they are more inclined to make the financial statement bulky and fatty, right? How come? They are just putting the accounting policy on everything, and probably sometime they are giving the accounting policy for immaterial item, but they are not giving the accounting policy for material item. And I can give you example for that. The total of the balance sheet is let's say 50 crores, right? There is a small item, of let's say intangible assets worth 10 lakh rupees or 5 lakh rupees, right? Or 2 lakh rupees. So the client or the entity or the auditor is giving an accounting policy on intangible asset which is only 1 lakh or 2 lakh rupees out of this 50 crore balance sheet. And there are some litigations going on, and the litigation worth 15 crore or 20 crore is there. Although it is a contingent liability, it is a off balance sheet item, it is a disclosure related item, but the accounting policy on this contingent liability provisions, okay, has to be given. Contingent liability accounting policy has to be given. So normally we are giving more weightage to the item which is in the balance sheet, but we are not giving weightage to the item which is off balance sheet. So technically AS 29 says that if there is a contingent liability, it requires disclosure, it does not require accounting, right? So it also requires accounting when it is meeting a threshold of, let's say, being a probable. For example, high chances are there that its liability will come, then you are required to create a provision. So friends, I have seen in case of banks, for example, the bank is having an interest income, 80% is having an interest, bank is having an interest income, and hardly 1% is income from lockers rent, right? The bank is giving the accounting policy on locker rent, but the bank is not giving the accounting policy on interest recognition. So para 24 says that if any item is material, the accounting policy should be given for that item. And when I say accounting policy, I mean to say recognition principle, measurement principle, presentation principle, and disclosure principle. This is required to be given, right? Para 25, 70, so para 24, 77% non-compliances means the entities has not given the complete accounting policy for all the material items, right? Para number 25 talks about, that all the significant accounting policies has to be given at a particular or at a single place, right? All the significant accounting policies has to be given at a single place with a title of, let's say, summary of significant accounting policies or significant accounting policies, and all the significant accounting policies has to be put on a particular place. It should not have been fragmented, it should not have been scattered. So it has been seen that although the percentage is very low, but it has been seen that the client or the entity is presenting these accounting policies at a different places, right? So it distracts the user attention because you are preparing the financial statement for the user. User could be the regulators, user could be the authorities, user could be the employees, user could be the creditors, could be the customers, could be the government, could be the tax authorities as well, right? So AS said that you are required to comply this para number 25 of AS1, and you have to collate and produce the entire significant accounting policies at one place, right? So this is the requirement of para 25 of accounting standard 1. Okay, the next one is the non-compliance relating to accounting standard 1 has been seen in terms of following the accrual system of accounting. When you look at the fundamental principle of accounting, it talks about going concern, it talks about consistency, it talks about accrual, right? So you have to follow the accrual system of accounting. For example, the client has deposited money into fixed deposit, right? And the client has not received any interest before 31st March. Doesn't matter. You have to recognize accrued interest on such fixed deposit on the basis of accrual principles, right? The client has paid an insurance premium of 1,20,000 in the month of February, starting from 1st March to 28 February next year. So going by the accrual principle, although we have paid 1,20,000 in this year only, but it is a prepaid expenses for 11 months and it is actual expenses for 1 month, right? So friends, accounting standard 1 compliance is very important. It's a very small standard, and normally we have a tendency to skip this standard. But I will tell you, before starting any preparation or audit of financial statement of non-corporate entity or an entity on which AS is applicable, you have to first start with AS1, right? And I would say this is not a theoretical AS, this is a practical AS. I would say this. Coming to AS2, AS2 is valuation of inventory. And two things I want to emphasize here. First thing, valued and certify the management will not work. Second, the measurement basis are FIFO and weighted average. LIFO is not there. The third one is the inventory has to be recognized at cost or market value. The inventory has to be measured at cost or market value, whichever is lower, right? Cost or net realizable value, whichever is lower. The word used is net realizable value, right? It is not market value. In so many accounting policy, I have seen that the word market value has been used. So friends, when you read theoretically, probably you will not find the difference between these two. But when you read theoretically and you think practically, you will find the huge difference. Net realizable value means estimated selling price minus estimated cost of completion minus estimated cost to sell. For example, let's say I am teaching financial reporting, right? And one of my colleague or friend is also teaching financial reporting. I am charging 10,000 rupees. So although I'm not a regular teacher, okay, I'm just taking a hypothetical example. So I am charging 10,000 rupees for a financial reporting subject. My friend is charging 8,000 or 7,000 rupees for financial reporting subject. Still students are coming to me, right? So for the same item, if I talk about price, so myself as an entity is charging 10,000 and himself as an entity is charging 7 or 8,000. So net realizable value is an entity specific value. Market value is a market specific value. What is the normal market price for that particular item? So there is a huge difference between fair value, market value, and net realizable value. Okay. Accounting standard 3, cash flow statement. So friends, the cash flow statement is not applicable for level 2, level 3, and level 4 entities. Cash flow is applicable to the companies, and cash flow is applicable to the level 1 entities who are non-corporate entities but having a turnover of more than 250 crores and having a borrowing of more than 50 crores, right? Coming to the accounting standard 4, which is talks about contingency and events after balance sheet date, right? So I have told you, you have to see the subsequent events post balance sheet date as well, right? And if it is significant event, it requires, you need to see whether it requires adjustment or it requires only disclosure. You have to see that. You have to see that, right? Accounting standard 5, it talks about your accounting policies, accounting estimates, and correction of errors, right? So accounting policies and accounting estimates. So friends, at some places you have to disclose accounting estimates as well. For example, useful life of property, plant, and equipment. Now we have a big confusion. What is the difference between accounting policy and accounting estimate, right? So all the significant accounting policies are required to be disclosed, but whether all the significant estimates is also required to be disclosed, answer is no in terms of accounting standard, but answer is yes in terms of Ind AS. So friends, accounting policy is a principle, accounting policy is a rule, but accounting estimate is an estimate. For example, depreciation has to be charged. Depreciation has to be charged over the useful life of the fixed asset. Fixed asset की useful life पे depreciation charge करना है. This is a accounting standard. This is a accounting policy, right? This is an accounting policy. But useful life, estimating a useful life is an accounting estimate. Useful life पे ही depreciation charge करना है, ये एक accounting policy है. लेकिन वो यूजफुल लाइफ क्या होगी एक एस्टिमेट है, राइट? आई कैन लिव फॉर 50 years, other can live for 70 years. Useful life is an estimate, right? There is a car which the car runs, or the car is driven in Delhi highways, right? Where the highways are very good, the roads are very good. So probably the car will run for 10 years. The useful life of the car is 10 years. Probably the car is running in a city where there are a lot of potholes, like lot of off-road is there, lot of a lot of poor roads are there. So probably the life of the car would be, for example, 7 years or 8 years. So useful life is different from one entity to another entity in terms of using of that particular fixed asset as well. Okay. So friends, accounting policy is a rule. Accounting estimate is an estimate. AS6 is no more. AS7 talks about construction contracts, and it talks about that how the accounting of construction contracts is there, how the accounting of contractors will be there. It talks about the percentage of completion method of accounting. Okay. Accounting standard 9, again a very important standard. Accounting standard 9, revenue recognition, right? Every company has a top line. Top line means revenue. When there is a revenue, there would be a revenue recognition. And when there would be a revenue recognition, AS9 will be useful. So friends, you have to think practically, right? For example, your accounting standard 9 talks about what are the conditions for recognition of revenue in terms of goods, in terms of services, right? And in terms of dividend, royalty, and interest. For example, in terms of goods, your AS9 says that, for example, that goods, revenue on goods are required to be recognized when 4 conditions are satisfied. What are those 4 conditions? And these are not theoretical conditions, right? When the significant risk and reward of ownership of the goods have been transferred to the buyer. When the significant risk and reward of ownership of the goods have been transferred to the buyer. When the seller is not having any effective control on the goods. When no significant uncertainty exists regarding the collection of the consideration. Or at the time of executing the transaction, it is not unreasonable to ask for the consideration. When you read it theoretically, you find it theoretical, but it is very practical, right? For example, you are doing an audit of a client, right? And your client is, for example, your client is selling Maruti cars. Your client is selling cars, okay? So while selling the cars, for example, your client is selling the cars, and while selling the cars, I'm the customer, okay? And I have purchased the car on 15th March for 20 lakhs rupees. And I've told the dealer that I don't have any place to keep this car because construction is going on, and I will take this car after 1 month, okay? So please keep this car in your godown. I have paid the money, I got the invoice, right? And seller is not having any effective control on that, right? Because seller is only holding that car, or seller is only keeping that car for the purpose of, or as suggested by the customer, right? Seller would not be able to sell this car to anyone else, okay? So he is not retaining any effective control. There is no uncertainty exists regarding the collection of consideration. Consideration has already been received. And of course, since the consideration has already been received, the 4th condition will not come into picture, which says that it is not unreasonable to ask for the consideration. So friends, for example, you have not read the standard very carefully. You have just read the standard. When you went to the godown of the client, you have found that the client has sold 20 vehicles in a particular year, but that one vehicle was lying in the godown, and the client does not want to recognize the revenue for that vehicle. Client don't want to recognize the revenue. Now the question comes. Whether the car which have been sold on 15th March but lying in the godown of the seller, whether the revenue should be recognized or revenue should not be recognized in the books of accounts in the period in which the car has been sold. Tell me. Whether the revenue has to be recognized or revenue has not to be recognized. Yeah, revenue has to be recognized. When you read these 4 conditions are getting satisfied, right? So in this case, revenue has to be recognized, right? So you have to see the AS9 principles very carefully. It has to be recognized on accrual basis. Revenue has to be recognized when these 4 conditions in terms of recognition of revenue for goods have been satisfied, right? And the 3 conditions in relation to rendering of services have been satisfied. And what are the 3 conditions in terms of rendering of services? The performance should be measured either by completed contract method or proportionate completion method. It means in case of services, you will be able to measure the completion, okay, completion stage. Second, no significant uncertainty exists regarding the collection. Third, at the time of execution of the transaction, it is not unreasonable to ask for the collection. Okay, right? Is it clear? Good. AS10, let me tell you friends, this accounting standard 10, property, plant and equipment, this standard has been changed effective from 1st April 2016. And lot of companies are still non-complying with the accounting standard 10, accounting for fixed assets, right? So friends, first of all, the recognition condition, the initial recognition condition and subsequent recognition condition. The initial recognition condition and the subsequent recognition condition is the same condition in the new accounting standard 10. For example, your client has a truck, okay? And your client, let's say the truck was purchased 5 years ago for an amount of 30 lakh rupees. And the client has replaced the engine of that truck. The client has replaced the engine of that truck. Okay. In that case, the replacement of the engine has costed, let's say 10 lakh rupees. Now it is a major expenditure. Okay. So the old accounting standard says that if there is a major expenditure which is resulting into the increasing the capacity, increasing the existing capacity. For example, if you have done some major expenditure and due to that major expenditure, 1000 cc car will become 1250 cc car, then only this cost has to be capitalized as per the old principle. But the new principle says that if you are doing any major expenditure and two conditions are satisfied, future economic benefit is probable and cost can be measured reliably. Of course, we are aware about the cost. But if you would not have replaced the engine, you would not have been able to run the truck. You would not have been able to get the services. So friends, in this case, future economic probable criteria is also meeting, right? So according to the new principle, the performance increase beyond existing capacity has already been removed, right? So if your client is spending a major expenditure on the improvement of fixed asset, on the repair of the fixed asset, you have to analyze that thing from the perspective of AS10. You have to look at that what should be the accounting treatment. It should be capitalized and the earlier part should be decapitalized or derecognized, right? So friends, if we read recognition condition, it seems very theoretical. Future economic benefits should be probable and cost can be measured reliably. But if you apply it in your day-to-day life, in your articleship training, you will find that it is not at all theoretical. It is completely practical, right? So friends, you have to see these things from the light of accounting standard 10. Second aspect which I want to highlight here. In accounting standard 10, so there are two methods which is available at the time of subsequent measurement. One is cost method and one is revaluation model. Cost model and revaluation model. Cost model means at a price when you have purchased the fixed asset, your gross block will remain same throughout your journey of fixed asset, right? Life of the fixed asset. But revaluation model means restating your fixed asset at fair value. So for example, your client has 4 companies, right? Your client has 4 buildings. And I've seen that the senior article are suggesting these kind of things to the owner or to the management. They said that, sir, and the owner is asking, I want to improve my balance sheet, I want to improve my reserves, what can I do? So one of the article is suggesting, sir, why not you revalue your one building? So you have 4 buildings. One building is Ludhiana, second in Panipat, Punjab, and let's say this Delhi building, right? So why can't you revalue this Delhi building? So the client is asking, I can revalue my building, but Delhi building has been increased manifold, but Ludhiana, Punjab, my Ludhiana building value has been decreased. My Punjab or Panipat building have been increased, or there is no change in my other building, right? So friends, before suggesting these kind of treatment, AS10 says that, and you are saying that please revalue only your Delhi building, right? You cannot suggest these kind of treatment. Why? Accounting standard 10 says that if you are applying a cost model or revaluation model, the model should be same and consistent throughout a particular class of asset. And this 4 building is one class of asset. So if you are revaluing one asset, you have to revalue the entire class of asset, right? You cannot have a cherry pick choice. It was available in the old standard, but from 1st April 2016, this cherry picking choice is not there. And if you are revaluing one asset, you have to revalue entire asset belong to that particular class, right? So you have to be mindful about that thing. Change in depreciation method, right? So change in depreciation method is again not a change in accounting policy. It is a change in accounting estimate. You have to be more mindful and meaningful about that. Right? So guys, these are some critical and practical aspect of accounting standard 10 which you need to apply. Accounting standard 11, it talks about changes in foreign exchange rates. So friends, while thinking or while looking at the AS11, you need to understand what are the monetary item, what are the non-monetary item. Monetary item are those item which is received or settled, which is received or settled in a fixed unit of currency. For example, debtor. I know I have to pay $50,000. Creditor. Sorry, I have to receive $50,000. Creditor. I have to pay, let's say $20,000. Right. So this debtor, creditor is loans, borrowings. These are the monetary asset. These are the monetary asset. Property, plant and equipment. Property, plant and equipment. Inventory. These are the non-monetary asset. Right. So my experience with the chartered accountants or CS students is, while applying the accounting standard 11, they got confused. What are the monetary item? What are the non-monetary item? In the balance sheet, you have to see what are the items where I know how much money I have to receive and how much money I have to pay. For example, for property, plant and equipment, you know the value, but there is no contract for receiving the money. There is no contract for paying the money. Understood? There is no contract for receiving the money because you have not sold that PP, right? For inventory, inventory is the stock which is lying in the godown or lying in your premises, but you have not sold the inventory actually. There is no contract giving you right to receive the money, right? So inventory, property, plant and equipment, these are your non-monetary item. Trade receivable, trade payable, loan given, loan taken, borrowings, these are your monetary item. So monetary item has to be restated at a closing rate, but non-monetary item has to be capped at a historical rate, right? So friends, while applying the practical aspect or practically while preparing the financial statement or while auditing the financial statement, you need to understand what are the monetary item, what are the non-monetary item. Okay. Then you need to understand what is the applicability criteria of this standard to those particular items, right? AS12 talks about accounting for government grant, not a difficult standard, rather I would say. So in AS12, you have to see whether this grant is in the nature of capital, it is in the nature of promoter contribution, or this grant has been received for the purpose of reimbursement of expense, right? So treatment will follow accordingly. AS13, accounting for investments, right? So when I talk about accounting for investment, and investment property has also covered in this particular standard, right? So the current investment has to be measured at cost or market value, whichever is lower. Normally, I have seen that, and in the standard, non-current investment has to be measured at cost less provision for decline other than temporary. Some people write that provision for permanent nature of diminution, right? So this word is not correct. Provision for decline other than temporary is correct word, right? Second, the concept of cost is there for non-current investment, not for current investment, right? So friends, I have seen that normally when the market is falling, when the investment price is going down, still the entities are showing the investment at cost value, right? Why? First, we got confused with the treatment of long-term investment. So if it become a current investment, you have to measure it cost or market value, whichever is lower. If the market value is higher, then cost would be there, right? But if the market value would be lower, then you have to restate it at market value. Okay. So you have to understand about the provision of accounting for investment. Accounting standard 14 talks about amalgamation, accounting for amalgamation. So you have to see what is meant by amalgamation in the nature of purchase, what is meant by amalgamation in the nature of merger, right? And accordingly, the accounting treatment has to follow. Accounting standard 15, there are some exemptions for level 2, level 3, level 4 entities. And of course, for entities, the actuarial valuation is important. The provision for gratuity, provision for leave encashment has to be done due to the accrual principle of accounting. Okay. AS 16 borrowing cost, guys. So this borrowing cost standard says that if the borrowing has been taken for qualifying asset, then you have to capitalize the borrowing cost. Okay. Now, what I have seen that, for example, the company has taken a borrowing loan for the construction of a factory. The factory has already been constructed and completed. The production has been started. Still, the borrowing cost, the interest cost is still getting capitalized into the factory cost. So friends, if you read accounting standard 16, it talks about your commencement of capitalization, suspension of capitalization, and cessation of capitalization. It means stopping the capitalization, stopping your borrowing cost capitalization. And it says that when your qualifying asset has been completed substantially, in that case, you have to stop capitalizing the borrowing cost, right? So it is not talking a completely. For example, you have seen the school building or you have seen the office building where the whitewash work is going on, where the paint work is going on, furniture work is going on, and the school has or of school, college or office has been started, right? It means the construction has been completed substantially. So when the construction has been completed substantially, qualifying asset has been completed substantially, in that case, you have to stop capitalizing the borrowing cost. Okay. Coming to AS 17, it talks about your segment reporting, and this standard is not applicable to level 2, level 3, and level 4 entities. And it talks about your business segment, operating segment, right? So the 10% threshold is there. So I believe, although this is a disclosure related standard, very presentation related standard, but I want you guys to apply this standard to your clients as well. You need to see, is there a different verticals, different component, different geography where your client is operating? Try to apply this AS 17 while preparing or auditing the financial statement. This is a disclosure related standard and the application will only come in the notes to accounts. AS 18, again a related party disclosure standard, right? So when you read the format of financial statement given by ICAI for non-corporate entities, or when you read Ind AS Schedule 3 or AS Schedule 3, you will not find the notes to accounts having related party disclosure. But again, I am saying you have to read theoretically, you have to apply practically and think practically. But when you read the general instructions for preparation of financial statement, it says that whatever, even in Schedule 3, it says that whatever we have given, it is the minimum requirement. But if there is any requirement of accounting standard or Ind AS, that requirement is required to be followed. Same thing has been written in the ICAI format as well. So this related party disclosure requirement, segment reporting requirement, is a requirement of the accounting standard, not Schedule 3, right? and hence it is required to be disclosed. By default, it is requirement of Schedule 3 also. Why? Because Schedule 3 says that if there is any additional requirement of accounting standard or Ind AS, that requirement is required to be followed and adhered, right? Accounting standard 19, leases standard, very important standard, right? So friends, in case of leases, you need to see first aspect, is it an operating lease or is it a finance lease? I would request each student who is watching this session right now or who will be listen or who will be viewing this session later on. My humble request to you guys is, while auditing the financial statement, please read the lease agreements, right? Please have a dialogue with the clients. Please inquire and discuss what is the life of this underlying asset. What is the lease period? What is the intention? Why you are doing this leasehold improvement? For example, the rent is 10,000 rupees and the client has spent 1 crore rupees in the leasehold improvement, right? So you have to, ask all these questions. You have to read the lease agreement, whether the option to purchase at the end of the lease term is available or not, whether the option of renewal is available or not, right? So this will give you the clarity in terms of classification of lease. Is it an operating lease or is it a finance lease, right? Why? Because the treatment is totally different in terms of operating lease and in terms of finance lease. As far as disclosure is concerned, the disclosure relating to minimum lease payments and lease receivable up to 1 year, 1 to 5 year, and more than 5 year is also required to be given. So friends, the lease term should be clear, right? And this disclosure should be clearly mentioned in the notes to accounts. But as far as level 3 and 4 entities are concerned, the exemption is there. Level 2 entities are concerned, exemption is there. In 2, 3, and 4, this lease disclosure is not required to be disclosed for up to 1 year, 1 to 5 year, and more than 5 years, right? Accounting standard 20, it talks about earnings per share. This standard is not applicable to level 2, 3, and 4 entities. Accounting standard 21, consolidation standard, it is not applicable to level 2, 3, and 4 entities. Accounting standard 22, provision for taxes, current tax and deferred tax. This standard is applicable to all the entities, except here there is a recognition exemption. For micro entities, which is level 4 entities, deferred tax asset or liability is not required to be recognized. So as far as level 4 entities is concerned, only current tax portion of AS22 is applicable. The deferred tax portion of AS22 is not applicable. And let me tell you, the 90% portion is deferred tax portion of AS22. Accounting standard 23 talks about investment in associate. Again, this standard is not applicable to 2, 3, and 4 entities. Accounting standard 24, discontinuing operation. This standard is not applicable to level 3 and level 4 entities, but it is applicable to level 1 and 2 entities. Accounting standard 26, intangible asset, very important standard. This standard is applicable to all the 4 entities, only on for micro entities, some disclosure exemption is there. So friends, for intangible assets, where the life is not certain, where the life is indefinite. For example, you have purchased a business and there is a goodwill, and you or your client is not able to identify the life of the goodwill. In that case, you have to assume the life as a 10 years, right? So amortization, like depreciation, you are charging depreciation on tangible asset, you have to amortize your intangible assets as well, right? Coming to the AS27, it is for the joint venture, and again this standard is not applicable to 2, 3, and 4 entities. AS28, impairment of assets, right? So friends, this standard is not applicable to level 4, but this standard is applicable to 1, 2, and 3. And let me talk about this standard a little bit. While preparing and auditing the financial statement as per accounting standard, and let me tell you, after COVID, so when this COVID was started in December 2019, so it's been 2.5 years, and I can say that after COVID, a lot of business have closed, a lot of business have not picked up, a lot of business have not started again, right? A lot of businesses are suffering from losses, right? So this standard plays a very pivotal role. This standard becomes very important and relevant in this scenario where you need to see the items which are reflected in the balance sheet at a particular value, whether the recoverable value is also equals to or more than carrying value, or the actual recoverable value is less than the carrying value, If the actual recoverable value is less than the carrying value, then you have to charge an impairment loss in your books of accounts, right? So in this case, you have to see what is the market scenario, whether the sales is going down, right? Whether the company is not able to meet cash flows in time, right? Whether the cash flows relating to that assets is higher than the cash inflow from that particular asset, right? So practically, theoretically, the standard talks about recoverable amount is higher of fair value less cost to sale and value in use. But for looking at value in use, you have to see the management projections as well. You have to see the life of the asset as well. You have to see the contract as well, right? What is my revenue contracts? You have to see all this stuff. Coming to AS 29, the standard talks about provisions, contingent liability, and contingent assets, right? So friends, my question to you guys is whether audit fee, and if I'm talking about liability, there are three kinds of liability: trade payable, your after trade payable, your accrued expenses, and your provision. So my question to you guys is audit fee, whether provision of audit fee is a provision, is a accrued expenses, or is a trade payable? Please tell me whether provision for audit fee is a trade payable, accrued expenses, or it's a provision. So guys, trade payable means a liability where it has been invoiced. I mean to say, if an invoice has been taken for a liability, invoice has been issued for a liability, it becomes your trade payable. What is accrued expenses? Something which have been accrued as per contract, right? For example, rent. The rent is from 15 to 15. So while closing the books of accounts on 31st March, if the rent is 10,000, so 5,000 has already been accrued, right? So this is accrued expenses where the terms has already been defined. Only the thing is the invoice has not come, or for example, it has to be paid as per contractual basis. And provision is something which is uncertain in terms of timing or amount. So बोलचाल की भाषा में हम कहते हैं कि ऑडिट फी का प्रोविजन कर लो, but it does not mean that you are required to do a provision for audit fee. This is not a provision. This is trade payable. Trade payable includes other expenses as well. Trade payable includes other expenses as well. Okay. So friends, let me show you the technical guide which is issued by ICAI, and quickly I'll discuss one or two aspects and then I'll hand over my session to Neha Jain, right? So let me give you, let you give me just 2 minutes and please confirm if this technical guide is visible. So any of the person from the host.
It is visible.
It is visible. Okay. Yeah. So let me show you the illustrative financial statement and we'll discuss 2-3 very important practical aspects out of it. So friends, if you see, there is a part 1 form of balance sheet which is given by ICAI on this June 2022, right? When you read this entire balance sheet format for non-corporate entity, so the first element is equity. I have told you 3 elements. The first one is equity. So owners fund is there, owners capital account is there, and reserves and surplus is there. In terms of owners fund, there is a owners capital account. In terms of partnership, partners capital account. In terms of proprietorship, proprietor capital account, and reserves and surplus. Non-current liabilities, long, and we have also talked about long, non-current and current, right? Long-term borrowings, deferred tax liability. Please write down. As per the framework of ICAI, this deferred tax liabilities and deferred tax asset will always be non-current. It will not be current. Other long-term liabilities, long-term provisions. Current liabilities, short-term borrowings, trade payable due to MSME other than MSME, trade payable. Other current liability, short-term provision. So my first question was audit fee. Whether audit fee is a trade payable or short-term provision. It is not a short-term provision, it is a trade payable. Audit fee is a trade payable, right? It is not a short-term provision, it is trade payable. My second question, what is meant by trade payable and how it is different from other payable? For example, I have purchased goods and services from my vendor and I have to pay them. Second, I have purchased a land from an authority and I have to pay that authority. Now tell me whether both of these items are trade payable, or payment for the goods and services, or payable for the goods and services is a trade payable, and payable for the land is not a trade payable. Trade payable is something which is payable for the goods and services. So employee related payables are also the trade payable. Tax related payables are the other payables, or which is your other current liabilities, right? So capex related payables are the other current liabilities, right? Good. Second question. For example, I have, or your client has given a capital advance on 31st March 2022. And that capital advance is going to be adjusted in June 2022. This capital advance is for the machinery, and the machinery will be given by the vendor in June 2022. Now my question to you guys is whether it is a short-term asset, whether it is a current asset or it is a non-current asset, right? So whether it is a long-term loans and advances, this capital advances, or this is a short-term loans and advances. On 31st March 22 we have paid, and it is going to be adjusted in the next 3 months. So I can say that many of the students are thinking, or many of the students are answering that it should be current. Answer is no, it should be non-current. Why? When this non-current, when this capital advance will be settled, it will give rise to a property, plant and equipment. It will give rise to a non-current asset, which is a property, plant and equipment. The destination is non-current, and hence the capital advance doesn't matter. On 31st March, if it will be going to be adjusted, it will be going to be adjusted on 2nd April. It will become your non-current asset. It will become your long-term loans and advances. Second example, the company, not company, for example, your client, be it a company or non-company, has given an advance for the goods and services, and this advance is going to be adjusted in the next 3 months. Is it current or non-current? So guys, this is for your goods and services. So it will always be, not always be, if it is adjusted within 12 months from the reporting date, it will be current. Otherwise, it will be non-current. Clear? I hope it is clear to all of you. So friends, going to the asset side. So there is a property, plant and equipment and intangible asset. So you have to give PPE number, intangible assets, CWIP, intangible asset under development, non-current investment. Deferred tax asset will always be non-current. Okay. Then your other non-current assets, right? Your current investments, inventory, trade receivable, your cash and bank balances, short-term loans and advances, other current assets. Now, one more example. What is difference between other trade receivables and other current assets? For example, your client is selling goods and services on credit basis. It is trade receivable. Your client has sold a building on a credit basis. It is not your trade receivable. It is your other current assets, right? So friends, on this entire format of financial statement, be it on the either side of the table, I'm not saying other side of the table, I am saying either side of the table, be it a client side or be it an auditor side, you are responsible for ensuring the compliance of accounting standards. As an auditor, if you are not having any, if you are not able to manage your client in terms of ensuring the compliance of accounting standard, you have to shout out on your client and you have to qualify your audit report and disclose that the client has not complied with this and this accounting standard completely. Okay, so you have to shout out in terms of the weapon which ICAI has given to you in terms of audit report, right? So friends, likewise, the P&L format is there, and P&L format is more, this balance sheet and P&L format is more close to Schedule 3 format, which has been given. Okay. And as I have told you, the current and non-current classification is also given. This current and non-current classification is given here. Okay. What is the operating cycle? What is current, non-current? So I would request each one of you that please read this technical guide on financial statement format for non-corporate entities. Please read the Schedule 3 for companies, and please relate the disclosure with the accounting standard. Apply it practically in 1 or 2 clients. I can tell you with my experience that when you will apply these things in 1 or 2 clients, you can self-analyze your level of knowledge, what was earlier and what is as of now. You can compare, you can demonstrate that where I was earlier and where I was today, where I am today. And let me tell you a very good saying in the corporate, what you have done has take you here, right? आपने बहुत पढ़ाई की, सब कुछ किया. So what you have done has take you here. But what will you do additionally will take you there, right? अब आप और क्या करोगे वो आपको आगे लेके जाएगा. जो आपने किया है अगर सेम ही करोगे तो आप और आगे नहीं जा सकते. So what you have done has taken you here. What you will do additionally will take you there, right? With this, I am concluding my session on practical aspect of financial statement preparation and auditing, and I'm handing over to the committee and Neha for the further proceedings. I hope the students.
Neha, you are on mute.
Thank you, Alok sir. It was really a very wonderful, insightful session. Although it's being a 10 year to be a chartered accountant, but still you have highlighted a wonderful point. It's really appreciable. Sir, there are few queries which the students have posted. I just want to reframe that queries for you. I'm just putting up to you. First is that, what is the prior period item concept in accounting standard AS5? What it says?
Yeah. So in accounting standard 5, it talks about prior period items. When I say prior period items, so for example, in last year, so you are preparing the financial statement for current year. And there are some error which have been happened in the last year, but it has been detected in the current year. For example, there was a purchase of a machinery and it was purchased for 10,000 rupees. Okay. So the accountant has to make an entry that machine account debit to cash account 10,000. But he has made an compensating or offsetting error and he has done an accounting entry with 1,000 rupees, right? So machine has been understated by 9,000 and cash has been overstated by 9,000. So balance sheet has been tallied. So now in the current year, this error was detected, right? So in this case, you are required to take the impact of this 9,000 in terms of P&L, depreciation impact in terms of P&L, right? And you have to show this item as a prior period item. So whatever P&L impact was there for the last years, you have to put the cumulative impact in the current year as a separate line item, as a prior period line item. Okay. So this is requirement of accounting standard 5. And in the current year, as far as balance sheet is concerned, you have to correct the balance sheet numbers.
Okay. Thank you, sir. The question number 2 is that, let's suppose there is a no accounting policy disclosure in the financial statement. What auditor should do?
Yes. So first of all, see, auditors are something who are expressing an opinion on the true and fair view of the financial statement.
Right.
And I have shown you the preface to the statement of accounting standard. It says that auditors are also responsible for examining the compliance of accounting standard, right? Accounting standard 1 para number 24 says that the accounting policy has to be disclosed for all significant or material item. Para number 25 says that all the significant accounting policies are collated and produced at one place. So it means if the client is not giving the accounting policy, it means there is a non-compliance with the para 24 and 25 of AS1. So auditor has to qualify that report. Auditor has to qualify the accounts in their audit report. So auditor has that weapon.
Okay, thank you, sir. Sir, the next question is related to accounting policy itself. They are asking, is it necessary to mention all significant policy in the financial statement?
Yes.
Or should they mention the all policies?
it is necessary to mention all the significant accounting policies. Please remember my example on intangible asset 1 lakh rupees for 50 crore companies, and my example for a bank where 85% income relates to interest income and 1% relates to locker rent. So it is not mandatory, or it is not advisable to put all the accounting policy relating to insignificant item, but yes, it is mandatory to put all the accounting policy on material or significant item.
Yes, you already mentioned that. Don't make your statement bulky. Okay, so the next question is, unsecured loan from the directors without agreement is there. What should be considered? Is it a short-term borrowing or long-term borrowing?
Very important, a very good question. And I would say, when I'll share my presentation, so this question is there, right? And Financial Reporting Review Board of ICAI has already raised an issue, and they have found this error, right, in the financial statement. If there are no terms and conditions, if there are no repayment, so in that case, you cannot consider that loan as a non-current. It should be current.
Okay, thank you, sir. Sir, the next question is regarding the MRL, which we are talking about, letter of representation. The student is asking that the company is incurring significant losses, but in MRL, they have provided us the assurance regarding the profitability in the future. They are saying that the company will incur the profit in the future and the losses will be wiped out and going concern is not hampered. So what kind of evidence and document we should obtain from them? What kind of external evidence or what kind of things we should obtain from them?
Right. So having a losses does not only talks about, there is a concern on the going concern. For example, you can see a lot of companies in India, Vodafone Idea Limited, they are preparing their accounts on a going concern basis, and they are every quarter they are generating a loss of 6,000 crores. If you see Flipkart is again a loss making entity, right? So still they are preparing their accounts on going concern. Make My Trip India business, again they are preparing their accounts on a going concern basis. So in MRL, having a profitability, I would not say only it is an indicator of going concern, right, will be corrected. So I think in MRL, you have to take an evidence that how management is confident that yes, they will be able to run their business in future. And when I say future, future is a foreseeable future. And when I say foreseeable future, it is 1 year from the reporting date. So you can see that there are lenders who are investing in the company and they are at advanced stage. The agreement have been signed, the equity date have been defined, the loan has been sanctioned, right? The company is in the advanced stage of getting the huge orders from the customers, right? So whatever products are there, the company is having a demand for that product, right? So all these sort of evidence, I believe, you are required to see while doing the auditing and getting it into the MRL. Another one is, many companies who are a part of a big group, they are taking a comfort letter from their parent, right? And I have seen in one of the client, even they are disclosing it in the notes to accounts as well, that the accounts have been prepared on the going concern as the comfort letter has been issued by the parent for repayment of liabilities and paying the expenses for running the operation in case if the subsidiary or this company will not be able to do. So these are some evidences which you can see.
Sir, really wonderful answer. But just really, I want to add one thing in this. What as an article, what you can do, you can take the projection for from the client also regarding how the profit will come and check the viability. This is also one of the possibility in the case of the small entities.
Yes. You are right, Neha.
Thank you, sir. Another question is that, sir, can you explain the net worth for the applicability of the framework of the financial statements?
Yeah. So as far as non-corporate entity is concerned, the net worth criteria is not there. Turnover and borrowing criteria is there. As far as companies are concerned, net worth criteria is there. So this net worth criteria is again more from the perspective of application of Ind AS, right? And it says that net worth means net worth which is defined under section 2 subsection 57 of Companies Act 2013. And when you read section 2 subsection 57, it says that net worth means paid up share capital plus securities premium plus reserves created out of profit. Please mind my word, reserves created out of profit. For example, if there is a capital reserve, it will not form part of your net worth. But for example, there is an investment fluctuation reserve, right? So you have provided this reserve, general reserve from your retained earning or from your profitability. So those reserves which have been created out of profit will form part of your net worth. So this is the formula which is given. And of course, if there is any fictitious expenditure or miscellaneous expenditure to the extent not written off has to be deducted. But the last line which I have said, fictitious or miscellaneous, this is not a right thing in today's context, because there is nothing called fictitious or let's say this this miscellaneous expenditure, right? So I believe this definition needs to be amended.
Okay. Sir, the next question is that what is the how can we identify the timing difference or the permanent difference?
Sorry.
Sir, it is explain how to identify the timing difference and permanent difference. What is the criteria for categorizing the timing difference and permanent difference in AS 22?
Yes. So being an article, I think the first privilege is we are well versed with the accounting standard. We are well versed with the income tax as well, right?
Right.
Because for being a chartered accountant, these are the two inputs or two raw material which is required essentially. So permanent difference means those items which are permanently disallowed, right, in Income Tax Act. For example, interest on MSME. For example, penalties of direct taxes, interest on direct taxes, right? So if you have paid interest on late payment of advance tax, interest on late payment of self-assessment tax, interest on late filing of return. So these are the permanent differences, because you have to spend money on that. There is an expense, but this expense will not be allowed, right? What is the timing difference? For example, provision for gratuity, provision for bonus, provision for leave encashment. So at the time when you have created the provision, it will be disallowed in income tax, but when you actually pay, it will be allowed in income tax. So it means it is not a permanent disallowance. It will be allowed when you will actually pay the amount, right? So hence there is a timing difference in this. When I talk about permanent disallowance, there is no timing difference, there is no defer tax, right?
Okay, thank you, sir. So there is a another good question. It is that if the company is paying premium toward the gratuity fund maintained with the LIC, how to recognize the gratuity in the financial statement?
Yes, very good question, very relevant question, I would say. And there are a lot of companies who are maintaining their gratuity fund with LIC or HDFC or other banks or institutions, right? So for example, and I would say it is not a premium, I would say yes, every year LIC or HDFC are asking some money for putting that money into the corpus, right? And let me tell you, they are taking your money, putting into the corpus, and they are generating the returns, right? So you can ask for the statement, and when I'm talking about statement, you can ask for the statement. What is the opening? What is my opening value of asset? What is the amount? Of course, what is the amount which I have paid? What is the amount which you have paid to my employees? What is the interest you have generated, and what is the closing value of the asset? Likewise, they will give you that this is the opening liability. This is the amount which is required. This is the interest cost. This is my payment, and this is my closing liability, right? So they will give you the asset and liability statement, and you have to take the difference between the asset and liability statement as an expense in your books of accounts. So likewise, you are treating into the likewise you are doing the accounting treatment in case of actuarial valuation. You have to ask those statements from LIC or HDFC, and you have to do the accounting treatment in the same manner, right? Because the only difference is in terms of having a non-fund based and fund based, the only difference is payout. Otherwise, there is no difference. And the expense has to be recognized on accrual basis. Doesn't matter you are paying or not paying, expense has to be there, right?
So there is also one important thing in that there will be no deferred tax in that case. If the company is following that gratuity fund maintained with the LIC, the payment amount and the expense amount will be same.
Yes, if they are paying, yes, of course, there will not be any disallowance. There will not be any timing difference.
Right. Okay, sir, I just brief out something. Can I?
Yeah, sure. Please.
Yeah, thank you. Hello, students. Myself, Neha Jain. It's been a 10 years to be a chartered accountant. I just simply want to provide you a gist whenever you do the audit. But the client accountants will do, they copy the financial statement from the last year and it handed over to you. But you students are basically worried, is balance sheet is matching or not? You just check the balance sheet is matching and you provide it to your principal. This is not the correct way of auditing. This is just the way of completing your task. If you really want to audit that financial statement, first, actually what you need to do, whenever the financial statement came to you, first you need to check which financial framework is applicable to the particular entity. Is it division 1? That is for the accounting standard entities. It is division 2, or is it division 3, or it is the newly accounting framework which is provided by the ICI for the non-corporate entity. Once you are confident, yes, this accounting, this framework is applicable, check whether the framework, whatever the framework is, has given the layout, whatever they have mentioned, you have to provide this thing, whether that particular, you should prepare a checklist, whether the criteria is meet out by the company or not. After that, you should, secondly, your step should be, you should the compliances of the accounting standard. Make the checklist of the accounting standard. Whatever the accounting standard is applicable on the organization, do check. Checklist is very important. Whenever you have the checklist, it is a real chances that you will skip the important things. But you need to do that. The accounting standard says what is the recognition criteria, what is the measurement criteria, and what you need to disclose. And this disclosure is make your accounting policies. The word format accounting policies, which you think, oh, what normally the articles will do in the word format, they just change the accounting year and they said, yes, sir, we have prepared the accounting policy, but this is not the correct way. The accounting standard checklist, which you have checked, check what that accounting standard say about the disclosure requirement and whether the disclosure requirement is meet out in the financial statement or not. After that, to an extent, your financial statement will be get ready for the framework which is provided by the ICI Schedule 3, whatever is applicable on the organization. So don't do copy and paste and try to apply the theoretical knowledge. Whatever we are reading theoretically, that is only the practically we have to apply. There is nothing new. There is no rocket science. The thin line of difference is only that we need to focus what we are actually doing instead of thinking, yeah, we are just only here to complete this task. No, don't do that. Whatever you are reading theoretically, apply that practically, and simply that will help you. Now I am handed over this session to technical team. I hope it is a wonderful session for all of you, and if this session will contribute 5% of your working style, we are really happy for that. Thank you, ma'am.
Thank you. Good afternoon, everyone present online. Honorable Chairman C.A. Sushil Kumar Goyalji from Student Skill Enrichment Board of Studies Operation, our Vice Chairman C.A. Sridhar Mupalaji, and the keynote speaker C.A. Pramod Jainji, and all the participants. It is such an honor for me to get the opportunity to thank you all dignitaries. On the behalf of Student Skill Enrichment Board of Studies Operation, I extend a warm welcome to the students present online in the webinar. I may express our sincere thanks to CA Dr. Alok Gargji for giving an excellent coverage to the topic, applicability of accounting standard for finalization and auditing of financial statement, and encouraging us with your words and enhancing the knowledge in a lucid way you presented to the students. A special thanks to CA Neha ji for providing immense support to make this webinar successful. I must thank the organizing team for working hard every weekend to make this series of webinars successful day by day. Thank you everyone once again for making it a great success. Dear students, stay tuned with us on every Sunday from 10:30 a.m. to 1 p.m. to enhance your skill sets on the practical upcoming topics. Thank you so much.